interesting time in the middle market for private equity. We've seen volatility in deal making, pressure to try to get exits and realizations for the LPs, and at the same time, a real evolution in how value is created, operational excellence, and a lot around AI-driven growth. I'm pleased to present on what Justin was telling us is day one of Winston-Taylor. We also are presenting our GP LP report today, which is called Taking the Middle Ground. You'll see it, there's a QR code on tables later
it's a very good report.
Where you can find it. And what's striking is that despite all of the complexity and despite all the challenges we've been having in deal making these past couple of years, there's still a lot of optimism that you're going to see that runs through the reports. But there also is still some discipline that folks are talking about that runs through the report as well, in terms about being much more selective, much more demanding, doing a lot more on the underwriting side going in, and trying to be as creative as possible as getting liquidity back to the LPs. So today we're going to unpack that and what it actually means in practice and how we're getting deals done and where the market's going from here. And as part of this, I'm very excited to introduce and be joined by Gil Ozir, Managing Partner at Beringer Capital. Gil leads Beringer's New York office. He sits on the firm's investment committee, and he oversees investing activity and the portfolio strategy. Beringer is a Toronto and New York-based private equity firm focused on lower middle market buyouts across North America. The firm specializes in tech-enabled services, data and analytics, and digital transformation, partnering with founder-led businesses to accelerate growth through strategic M&A, operational improvement, and talent development. With over $1.2 billion in assets under management across 3 institutional funds, Beringer is actively deploying out of Fund 3. Notable portfolio companies include Benzinga, one of the largest financial news sites in the world, Dig Insights, an AI-driven and market research company, and Verdata, a data and analytics platform that supports nonprofits with donor acquisition. Before Beringer, Gil spent time at McKinsey and later led North America for AMR International, advising on strategy and M&A across media and technology, and he also ran a family office for several years. And what's most important is that Gil contributed directly to our report.
There you go.
We're discussing today, which gives him the honor of sitting here with us, and we very much appreciate that.
I relish the honor.
Thank you. So let's get started, Gil.
Let's do it.
Let's do it. Okay, we're going to talk about liquidity, DPI, the exit backlog. A lot of that is discussed in the report. There's a lot of pressure from the LPs now to drive that DPI and a real need to return capital. So how is that pressure changing how GPs think about deals and deal activity today?
Well, I think DPI has gone from really being an output to being a central part of the strategy. When you had an asset, the goal was you hold it for as long as you reasonably can to maximize value. Today, you have LP base that have their own liquidity concerns, right? They need to recycle capital back into new commitments. Those new commitments may even be into your own subsequent fund. And so I think we really need to be very sensitive to that. And maybe the answer changes somewhat. Maybe it's, what's in the best interest of the company, what's in the best interest of the GP, but what's in the interests of the LP's needs right now. And what does that look like? I think it can look different for different situations and different funds, but maybe it looks like selling off an A asset a year or so quicker than you would have ideally liked to. Maybe it means finding some kind of liquidity, whether that's through a dividend recap, whether that's through a continuation vehicle or a minority sale. And maybe it means, frankly, just being a little bit more selective around deployments if calling capital is going to create friction with your LP base. But I think ultimately, it's very basic. It's follow business rule number 1, which is focus on the needs of your customer. At Beringer today, we're saying, let's take care of DPI now, and long-term, good things will follow.
Okay, under the focus on the needs of your customer, you talked also about recapitalizations. We may hit a little bit on continuation vehicles. Are these a solution to that problem, or are they causing the problem?
Truth be told, it can be a little bit of both.
Yeah.
I mean, at the end of the day, a continuation vehicle, it's just a tool. Whether or not it's a good tool, that depends on the quality of the asset that's underlying and the rationale for doing the continuation vehicle. So I think for LPs, the question is really a simple one. Is this being done because the asset deserves more time or because the GP needs more time? Because you certainly have plenty of CVs that have been done, and I'm not being critical, it's just part of the market today, where they contain assets that frankly should have been sold. And we're kind of kicking the can down the road, and LPs would be right to be skeptical of those. On the other hand, you have situations where a continuation vehicle can really provide a very elegant solution. You have, call it a trophy asset. You have a GP and a management team that's ready to roll their stake alongside new capital to grow the business to the next horizon. And you have LPs who would at least like the option of liquidity. So kind of everybody wins as long as the pricing is right, you have the right governance around conflicts, there's a real plan for the company. So I think in those situations, LPs should look favorably on continuation vehicles, but the burden lies with the GP, right, ultimately.
And making sure the story is told around the reasons for doing it.
Absolutely.
Yeah. So liquidity is forcing this action and these conversations, but getting deals done right now is not easy.
When was it easy?
Yeah, I know. It was never really easy. No, right. So the report highlights a lot about some of the friction around due diligence and how that's become really the most challenging part of the deal life cycle, and that there's still competition for really high quality assets, and that remains incredibly intense. So how would you characterize the competitive landscape of doing deals today?
It's definitely competitive. It's been competitive for a while. I think the way I would characterize it is it's an uneven market. Uneven in the sense that you've got GPs all running to the same limited number of A assets. Okay, that happens. But what's unusual is you've got a ton of, let's call them B assets, that are sitting in portfolios today. A lot of them are perfectly decent companies, but those deals are just not transacting at the volumes that we would expect. And I think part of that is GPs being reluctant to do a deal that underwhelms their mark. I think part of that is also on the buy side, GPs not wanting to call capital for an asset that's merely okay, given all the liquidity pressures we discussed. So that's what's creating the logjam in the market, and we have not seen it break yet.
So when we had our conversation, our pre-call, you talked about two things that you're looking for in companies today. Can you talk about those two things?
I mean, I think all the classic things apply. I mean, you want a strong market, you want a strong competitive position, a good man, all of that still applies. What I'm feeling now is there's a heightened focus on business resilience. Watch the news, as depressing as it is. We live in a much more volatile world. And so the question that we're increasingly asking is when the market turns, macro risk is back, right? Yeah. When the market turns, how does this business break? Is there a underlying fundamental risk, either around distribution, a customer, key management team? Are the revenues more transactional versus recurring in nature? Does the company have multiple pathways for growth, or is there only one? So if the market turns, you're kind of stuck. And then, of course, there's AI relevance. Will this company continue to exist? Yeah. And what's interesting is you're seeing a lot of this come together because we've noticed where you have resilient, let's call them AI-safe assets that are being aggressively bid up in processes. we were involved in one deal for a business. It was a funeral concierge business that was tied to whole life insurance policies. So what can be more stable, death and insurance, And this thing got bid up to like anaerobic levels. We were just like, whoa, we didn't expect that. We didn't bite on it, but the penny really dropped, which is, wow, there's a real premium being paid here for safety. At the same time, you've got to be careful because safety at the wrong price is risky. I mean, I like to sleep at night too, but I'll deal with some insomnia if it's so expensive,
And we also talked about how the earlier, deeper underwriting has maybe changed some of the process that you do today. Maybe share a little bit about that.
Well, I think we've moved from a situation, kind of coming out of COVID in particular, where the fundamental basis of competition was around valuation, everybody upping themselves on valuation. I think now that's become more muted and the spreads have narrowed, but now the battlefield has shifted to speed and certainty of close. Well, talk about the volatility. Well, when is this shoe going to drop? I want my deal done. Right? So when an A asset, a competitive situation comes through the door, you have to be prepared to move immediately. That means hiring your advisors, aligning yourself with whoever in the industry you're going to work with, and starting to do work. And that means sprinting to a fully diligenced LOI bid. And that's resource intensive, and that's really difficult and expensive. So you have to be, I guess, judicious about when you do that and how often you do that. But that's kind of table stakes. I think the problem you get into is when you sacrifice judgment on the altar of that speed.
Yes.
Yeah.
Yes. Well, it's interesting because our GPs we're always trying to do a risk assessment about what we do when, even on the legal side, on docs and diligence side, how much, what are the special areas that we're doing. And it's very surgical now to try to get you guys there as quickly as possible, managing the fees as much as possible, but looking at the most critical stuff as much as possible. I mean,
but you miss stuff, not you guys, but buyers miss stuff now because of this rush to get deals done. We were involved in one deal last year. I think we were probably one of 3 final bidders. And one of our competitors basically came in, short-circuited the process. We're ready to sign now. And we haven't seen enough data like around renewals, around customer behavior to really support that kind of move. So we stepped back, but it turned out those ended up being real issues for the company. And so I think speed is great, but discipline matters more, and you can never, never, never abandon your underwriting standards just to get a deal done.
Okay, so let's assume you win the deal. Where does the value actually come from? Where are you seeing now in terms of operational execution and what you're doing to create that value now?
Well, I think value creation is probably more important than it's ever been. And people have been talking about this in the industry for some time. But just to kind of put it in perspective, Bain issued a report about 6 months ago, I want to say. And in that, they analyzed historical private equity returns. And they showed that historically, you only needed about a 5% annual EBITDA increase every year in your portfolio companies to hit your MOIC threshold. Today, cost of capital has gone up, asset prices have gone up, multiple expansion is more muted or doesn't exist. That number is 12%. So you're not going to get 12% EBITDA growth across your portfolio unless you have real value creation chops. And that looks different for every firm. Everybody does that in their own way. But I think a lot about how much of it comes down to DNA and culture and talent. At our firm, for example, we were actually founded by industry veterans. So we've always had that very strong operational bent. And increasingly, we're bringing in more talent from industry, more talent from strategy consulting, because we view those as more aligned with value creation. That's not to say the finance and the deal making, that's all important, but that's where you win at the end of the day.
Yeah. So we also talked about AI on our pre-call too.
Can't have a fireside chat without talking.
I know you can't. So we're half into it now.
Yeah,
We're
that's
talking
right.
about it,
That's
right.
We're coming around
So
the.
we're coming around the
yeah.
So tell us about what you're doing there, either as an investing team or with your portfolio companies themselves.
You know, when you meet a portfolio company today or new prospective investment, the question isn't so much are you using AI, because everybody is, or at least they say they are. The question is really, how does AI strengthen your moat or weaken it? And you really want to get to the heart of that. And some of the way that we approach this is we're working with a company just as a board or as a new, like, I want to hear the nightmare scenario. You know, walk me through how this business does not exist in 3 years because of AI. Like, what's the solution that's going to kill it? Who's going to do it to us? And how long is it going to take, right? So we wake up from that fever dream.
Yeah.
And then we say, okay, now what can we do to defend against it? You know, is there a moat that we can build back up? Because maybe we have proprietary data. Maybe we have embedded customer workflows. Maybe we have specialized domain expertise to defend. What can we do offensively to, again, bring that moat back? Are there things that we can use AI for to build better customer outcomes, to make our revenue stickier? You know, and then of course it comes down to, does the company have the right talent? Does it have the right infrastructure to be able to do all this? I think the best companies we work with and engage with, they have answers to those questions before you ask. But others are kind of catching up, I would say.
So talk to us about using AI as a tool for revenue growth, just not the cost savings. And how are your portfolio companies putting that into practice?
I think it's an incredibly important distinction, because we're already starting to see the dividend of productivity gains through AI. I mean, we see it at our own companies. We see kind of margins ticking up in some of the deals that we're looking at. My fear is that ultimately that becomes deflationary.
Yeah.
Because, oh, you're so efficient now, I'm the customer, you're so efficient now, why am I paying so much? So I think what is more valuable but harder to realize is AI to drive customer outcomes and revenue growth. You know, I'll give you an example. You referenced one of our portfolio companies, Veridata, which is a data and analytics company. They help nonprofits with donor acquisition, chiefly through direct mail channel. Historically, they've always used machine learning to really pinpoint which audiences are going to have the highest propensity to donate to an appeal. Now they're using AI to prescribe what the creative needs to be. When does it need to be timed? Who does it need to be addressed to? What font? What envelope size? All to optimize conversion. So that's very valuable. You know, that creates more revenue, more budget, more stickiness. So as an investor, I'm not against AI for productivity's sake, but I'm much more willing to pay a premium when AI is being used to drive client outcomes. I see that as more valuable.
Yeah, okay. Switching topics a little bit, let's talk about fundraising and LP selectivity. So our report suggests that fundraising remains challenging. I will acknowledge I don't know that we needed a report for that, but it's in there. But not just because.
Good to know, though.
It's good to know.
The confirmation.
You know, LPs are more selective than ever. So what separates the managers who are getting funded today from those who are not?
We talked about DPI. I think that's a critical metric. You know, I think we're moving from a time when like storytelling was enough, where you could say, here's our fund, here's our pedigree, our people, our track record, to a time where proof points are becoming central. And you know what that means, the conversations we're having with new LPs, for example, they want to know, you know, not, oh, we invest in middle market companies and 5 million EBITDA and, you know, business. No, they want to know which sectors, which subsectors. Show us your investment theses that are related to that. Show me who you're aligned with in those industries to make that happen. What skills, knowledge, experience are you bringing to bear to make that happen? I think another piece is around attribution. The returns are not enough. People want to know why, where did you get those returns from? Was that because of clever financial engineering? Okay. Was it because multiple expanded in the last few years? Okay. Or were you applying real value creation playbooks, generating operating leverage? Were you in benign markets, or did you make money when the market turned against you? Like, those are the types of conversations and proof points that are needed today. So people want to know, are you buying smart? Yeah. Do you have a repeatable methodology for driving value in those businesses? And are you returning capital?
So we talked about DPI as something that they definitely want to see. What else are you seeing LPs talk to you about around DPI, track record, strategy, repeatable proof points and value creation? How are those conversations?
I think with new LPs, DPI is kind of what gets you through the door.
Table stakes.
Yeah. But what they want to see is the nexus between that DPI and everything else we talked about. The value creation, the return. It's not that all that other stuff doesn't matter. It's just taking a back seat, and it's more how you link that to the DPI that you've created.
Great. Okay, so this was meant to be a short fireside chat, so we're going to just do a final question.
Sure.
Looking forward, the next 3 to 5 years, what do you think will define a top quartile middle market manager?
Assuming the robots don't take over and
exactly.
We all just play golf and write poetry, maybe, but it's actually hard to know. But I think there's some things you can look at today and say that's probably going to be more important. Mm-hmm. I think discipline around entry multiples. We're living in a more volatile time, and that means more asset bubbles, right? We keep seeing these things pop up. So your ability to navigate through that and not get caught in a bubble, I think that's going to look very favorable in your returns over time relative to others. I think innovation, we talked about AI. There's a lot of really cool experimentation now happening in private equity of downloading data sets and SIMs and using it for pattern recognition. I think ultimately a lot of that gets starched out because everyone does it, but there will be firms that find real differentiating capabilities that are going to drive their returns. I think maybe this is a bit squishier to your question, but we're also in a world where trust is more scarce. And so those LP relationships, are gold. And the transparency of communication, the gold standard governance, and going back to where we started, just constantly aligning your outcomes to the changing needs of your LP base. Back to business rule number 1, focus on the needs of your customer.
Yeah. Look, thanks so much, Gil, for
pleasure.
For talking to us and for contributing to the report.
It was fun.
On the QR code. It's a challenging time, and I love your theme about going back to the customer. Many of them are here in the room. It's a tough fall, a little challenging time, but we want to hear from the LPs, and we want to align with what you guys want to be doing and want us to be doing. So very appreciative.
Thank you.
And welcome to day 1 of Winston-Taylor. So thanks for being here.